Welcome to Fireside Chat. My name is Sai. I came across this article from the Wall Street Journal, why target date funds might be inappropriate for most investors. I don't invest in any of the target date retirement funds because I'm not an average investor, so I never will. Let me break down and tell you why. If you have a brokerage account, and it doesn't matter if you have the IRA, 401k, TSP, or the taxable brokerage account, you can choose to invest in the target date funds. These funds are basically what I call invest and forget for the average investors. If you're not a fan of doing research on stocks, following the stock market or its news, or the stress that you get whenever the market is down, then make sure you pick the correct target date fund, or in the TSP, they call it the life cycle funds. Picking the wrong target date fund could potentially lose you a lot of money in the long term. So you're going to pick the life cycle fund based on the year you're retiring. For example, if you're turning age 60 during the year 2050, then the 2050 life cycle fund in your TSP will gradually reduce risk by changing the investments within the fund. Let's look at the Vanguard Target Retirement 2050 fund. Let's say you're turning 59 and a half around the year 2050. The expense ratio is 0.15%, which is still lower than most of the actively managed mutual funds. This portfolio breaks down to 54% US total stock market index fund, 36% total international index fund, 6% total bond market index fund, and 3% international bond index funds. So that is about 90% stocks and 10% bonds as of 2022. Keep in mind that the allocation of these funds will change every single year. So if I go to the 2045 Target Retirement Fund, the allocation is at 88% stocks and 12% bonds for the year 2022. You see how every year the stock allocation will decrease as the bond allocation increases. This is called a risk reallocation every year. So when you're approaching your retirement age, like looking at the 2025 retirement fund, you will be at 55% stocks and 45% bonds. My point is, if you're in your 20s, then you wouldn't want to be so conservative in your portfolio allocation. Remember the rule of 120 I talked about in the other video. You want to subtract your age from 120, and that gives you the stock allocation percentage. And this is not financial advice, but let's say I'm 35 years old. So 120 minus 35 is 85. So if I'm an average investor, I would make my portfolio about 85% stocks and 15% bonds. However, I am not an average investor. When I joined the FIRE journey, and I'm going for the fat FIRE here, I decided that investing in stocks would give me a heck of a lot more return in the future. Okay, I know financial advisors or planners would hate hearing this because I'm not taking risks into consideration. Let me go back to the article I was talking about earlier. Professor Jonathan Parker from the Massachusetts Institute of Technology, if you guys didn't know what that is, that's the MIT, along with PhD candidate Aaron Goodman and assistant professors at the University of Illinois Victor Duarte and Julia Fonseca, used historical data to set up a model of the game of life, or in other words, the risk economic environment in which people earn, save, and invest over their lives. So they created an AI program to play this game of life over and over again with different variables, and found that average retirees should take more risks than the Target Retirement Fund. Take a look at the 2015 Target Retirement Fund from Vanguard. This is assuming that you're already retired. The portfolio allocation is only 30% stocks and 70% bonds, with a 1-year return at 5%, and it's at 6% since inception. According to their AI program, it's much more optimal to be exposed above 60% even after you turn 65 or older. Now, there's no one-size-fits-all model for everyone because everyone's situation is different. Professor Fonseca recommends much higher allocations, and the following three play the biggest roles. The first is your wealth. An investor with greater net worth is able to take on more equity risk. On average, for the wealthiest of investors, the model found that the optimal equity allocation is close to 100% even during retirement. That's 100% stocks. In contrast, the average recommended equity allocation for those with the least amount of wealth is around 20% stocks during retirement years. Second is state of the business cycle. They're suggesting that investors should have higher equity allocations in their retirement portfolios during economic recessions than during expansions. So that makes sense, because what did I do when the market crashed in March 2020? I bought way more stocks. When the stock market is bleeding and there's fear in the market, this is the right time to buy more if you believe in the economy for the long term. Third is the market valuation. These researchers use dividend to price ratio to determine if the stock market is overvalued or undervalued. The higher the ratio, the cheaper stocks are. Their model found that investors should have higher equity allocations when the dividend to price ratio is high. If you want to read further into this article, I will leave the link in the description below. The investment strategy to me depends on my age and my risk tolerance. I want to achieve fat fire. Our fat fire number is $2.8 million, but it doesn't mean that's when we stop investing. We want to grow to $5 million, $10 million, and maybe $50 million. In my personal opinion, and by no means this is financial advice, in order for us to achieve fat fire, these target retirement funds will not get us there. And we are going all in 100% into stocks. Well, 95% stocks and 5% crypto. As our wealth increases, we can become even more aggressive with the equity allocation like these guys are talking about, because we will have more room to lose. If our net worth is $50 million and we lose $1 million, then it's probably not going to make a big dent out of it, right? If you're brand new to investing and you want to take some time to learn about the stock market, parking your money in the target retirement fund is not a bad thing to do. So you can invest and forget and let the target retirement fund do all the work for you. However, if you're on the fat fire journey like me and you want to build an aggressive portfolio, take the time to do some research and get 10, 15, or even 25% average annual return for your portfolio. So with that said, I appreciate you watching my video. Don't forget to subscribe, and I hope to see you in the next video. Have a good one.